Markets with May, and we are going to talk about Upstart today. It's been a while since I've been doing any online stuff. Sorry about that, guys. I just got back from Paris and just didn't really feel like doing too many more videos on the near term, but I am still pretty active on Twitter, which you can see down below. I wanted to test the system because as a preview later this week, we will be doing AMC. Actually, tonight, I will probably post a live cast on AMC's earnings. But since I did have some requests specifically for Upstart, I wanted to go through the quarter and put this video out there. It was a terrible quarter. I have no position in Upstart. I had no position stupidly going into this earnings report because I really should have known. Past performance is not indicative of future returns. Let's get straight into it. All right. One second. I think the key thing is I've gone all over the map a little bit on this one, to be fair. I have posted my previous videos in the link down below, and you can kind of see that at one point I was very bearish this stock, and I was bearish for reasons that I was a little bit early and that played out this quarter. And so I really do think that man, catching this falling knife, you really have to be a special someone because, well, let's just go through it. Okay. Let me share my screen. Okay. Here's the headline numbers. And you might be like, oh, maybe it's just a 1 quarter thing because you do have operating income and net income improving. So you've got here 157 down to 134. That's coming from the fact that they're not doing as many loans. Needs to be discussed. But they did have higher interest income and higher expenses. But I'm going to tell you, even if you're going to be excited about that, we kind of need to talk about it a little bit, because the reason that's happening is the exact reason why I originally had such a bearish thesis. And then net income up 28%. You might be like, oh, this is a lower loss, so maybe that's good. Tough. Okay. Shares outstanding increased by 2.7 million shares because they do need to fund this thing. And even though they do have some sources of capital that might be a little bit newer, you've got some actual problems here. And in fact, I think there was a moment during the call, during the Q&A, when they really discussed the fact that they truly do need interest rates to start to decline for them to be okay. And there's more than one reason for that, not the least of which is that it'll help the consumer. So let's actually talk about the slides that did them under. First, there's one in particular, but leading up to that, it's important to understand lending by product. You can see that the number of loans was down significantly from 185 last year to 113. It's an uptick in personal loans. But if you're to do the math on this, then you'll see that you are getting personal loans that are about $800 bigger. So these loans are about $10,000. They were slightly under $10,000 in Q3 of 22, but people are asking for bigger loans, and those that are getting approved are actually, taking advantage of that. So that, and then you can see the fall off in the number of auto loans. And here's where it gets very dicey if you want to go long right this minute without greater clarity on rates decreasing. The reason that they didn't do more loans when asked about it wasn't because, oh, there's not a demand for car loans, because that would have been completely false. There's just demand like crazy for car loans. The problem is the nature of the car loans that they write. I've talked about this in the past. The car loans that they write, really, it's always been unclear to me, what exact bucket is this? And they give this is the crazy thing. They give this, a lot of times, Upstart will give this FICO score slide where they talk about how they do a better job by bucketizing into smaller FICO score areas. But then I'm like, well, what's the default? Like, how's it? You're doing all this work on the FICO scores, but what is the mix of loans that you have? Like, what kind of lender are you? Especially, which was my original bear thesis, now that you're keeping those loans on balance sheet. If you weren't keeping those loans on balance sheet, if all of those are being securitized off such that you had very few loans held for sale, I'd be fine with that. But the problem is that you actually started keeping those loans on balance sheet last year, 2022. And then by the time I got bearish, you were at $1 billion. And quite frankly, the balance sheet hasn't improved since then. They're back at around $1 billion. They just keep bobbing plus or minus that. They're an asset manager at that point. And if I want to assess the validity or the viability of you as an asset manager, I need to see more loan data. We got a little bit of that, but we still don't have average FICO score. We still don't have stuff like that. But what we do have actually makes you even more concerned that you don't have that data. And so let me show you the reason that the auto loans and the reason we're concerned is because the reason the auto loans fell off a cliff, almost half of what they usually write, is because in order for them to write more, the interest rate that they would have to charge is above what they would typically charge. It would be greater than 36%. Well, greater than 36%, I know what kind of clients you're actually writing those loans for. That tells me that half your clients dropped off because they were going to be charged either a UMI, a monthly payment that made no sense, or alternatively, you're going to have to give them a crazy interest rate to the tune of greater than 36%, which tells me most of your auto loans are subprime. Okay, I'm just going to call it like it is. And if it weren't the case, then let's just go back to this slide. This number wouldn't be less than half of what it was in the second quarter. Now, they also talked about the idea of what happened between first quarter, second quarter. They said it was in the last 90 days, significant credit deterioration. And this is really where the story goes from not great to super bad. Okay, so number one, I just want to show you very quickly the total loans held on balance sheet, 972 versus the 700 million Q3. This number, the collateralized portion, they're doing some sort of partnership with that. So they're saying that should be 43. So maybe you could say that there's a little bit of an improvement because you have to take this and then just replace it with 43 from the second quarter. However, there's some things, and even some of the analysts kept asking to try to tease out the things. And the things is, how is it or why is it precisely that the testing and evaluation loans that you're holding on balance sheet continue to remain so high? Like, would have thought at this point, if it was, the model is more or less okay, that you don't necessarily need to increase so aggressively. We go back to what it used to be as relates to the testing evaluation. This actually speaks directly to why I was originally bearish. And it bums me out because honestly, I think they do a lot of work. I'm never rooting for a company to fail, but this is a problem. And the problem is this actually is not the easiest graph to understand if you're not used to seeing these types of graphs. The green line is the expected flows. Okay. This is another way of saying, given that I made these loans, what kind of cash, and I incorporate in what my AI model is saying is the default rate plus the recovery rate, right? So let's say they're auto loans, certain type of people given a FICO score are just not gonna be able to pay it off. They're just gonna give you back the car or something like this, right? So given what my AI model is saying is the default rate plus the recovery rate, what's the deal? Like, this is the cash flow. The green line is your cash flow. This green line is the cash flow. The dots was actually the expected cash flows. So this was your targeted cash flow. The dots was the expected cash flow. This is actually the underperformance. Okay, that's really bad. And it's really bad because it speaks directly to the concern that I had, which is, what is your credit rating and how do you really know? Because the interest rates turned so sharply, turned on a dime. And because even though in the prime banks, in the regular banks that I usually cover, things are actually fine. The loss ratios are really just normalizing back to 2019. The problem is when they started taking on so many loans, I was like, ooh, I'm pretty sure that the loans you're keeping on balance sheet are the subprime ones, because if you'd probably anyone would buy a bunch of prime auto loans in this kind of marketplace. And sure enough, this kind of demonstrates that that's what's in those loans. Now, again, one other thing that may not be straightforward is that these dates don't represent the vintage quarter, meaning the date that you made the loan at. Okay, so these loans were made in 2021, meaning you've got 2 years of people paying it off, and you probably are a little bit before the crazy run up in auto in used car prices, and then it plummeted right during 2022. So these guys are actually doing okay. The guys that have the dynamic of both rates, like actually rates are still pretty low 2021, but the folks that have the increasing in rates with used car prices plummeting, these three vintages, this one barely starts it, but these two, right? These guys aren't experiencing as good of a time. Now, you might just be like, okay, well, if that's it, that's over. No, this was my whole point, but I want to explain it one more time because I showed this graph and I discussed this on the last call. I know it's not straightforward if you're not used to risk management, risk calculation, any of that. Default is done via what's called a Poisson distribution, and it looks like this. Okay, you model spits out some probability of default over the period, and these dots represent the incident of default over a given period of time. So, if you have, very low probability of default, then you have maybe one incident, and then very few incidences going forward. If you have, that sort of thing. The challenge with the Poisson distribution of default, the challenge that we all the challenge that we all learned in 2008, which is the core to why I was so concerned about Upstart and the fact that it was holding so many loans on book, is that there is correlation to default risk. What does that mean? That means that your model will exactly be wrong if, for example, some event is actually creating joint default probability, meaning I wrote the loans in one environment and my model took into some things consideration, but it didn't take into consideration the one thing that would make all of these people default at the same time. That's okay. That's what's happening given what you see. I mean, that probably, like, there's lots of different ways to show it, but unfortunately, seeing this absolutely is one way to show it. And the worst part of seeing this is that you actually don't know what the terminal fully executed default rate is on these other vintages. Meaning, okay, so the folks in 2021, they're still having the toughest time. Cool. They've been around for one quarter more than the folks in 2022, et cetera, et cetera, et cetera. Because the deal with correlated default probability is that it basically means that you had a lot of events a lot faster than you expected. And so, those guys that defaulted hung in there for a good solid 3 months. And then those guys that, they're, what's the probability that that same group of people can hold in there 4 months or 5 months or 6 months? Okay, so the longer that this goes with defaulted payments, the more aggressive it can be. Now, I wish that they had been like a bank and showed me what a bank will show that Upstart still continues to fail to show, because this was not their original business model. They're way outside. The problem is they're way outside of their original business model. Their original business model was, I'm an originator, I don't hold these loans. But if you're going to hold these loans, for me to assess the problem, if there's a problem with you holding the loans, what I actually need to see is a 30, 60, 90 day vintage, 30, 60, 90 day buckets of whether or not things are getting worse. And every single bank will show 30, 60, 90 days of non-performing loans. We're not getting that yet from Upstart. What we are getting is this thing, which, I can try to be really clever and derive something, which is these recent vintages over the last 3 quarters are performing in line with the model. Okay, you've got a really wide band, though. This dotted line band, suggests that they believe, especially as you move forward, and there's the potentiality of rates decreasing, that you have, prepayment. People refi those auto loans, and so but if you don't, then you've got an even wider spread, and that's very statistical and very beautiful. But which told me is that you feel good about Q4. You feel a little bit less certain that your model was correct in Q1, and you feel even more uncertain in Q2, both that they could outperform and, unfortunately, that they could underperform. And if anyone that's going to make an investment today in Upstart is going to have to feel confident that that model has actually adequately tweaked itself. My suspicion is as relates to these guys, and it would have been, quite frankly, a common mistake among most risk managers to tell you, let alone anything else. Okay, this I called this in December, and I took a lot of flack for it, but this is the most common modeling mistake that you'd ever see. Um, they probably are in a better spot, because my suspicion is whatever they did to the model, they baked in a little bit more cushion. The situation that probably, I think that the tail on some of the older vintages still is going to show a little bit ugly, because the number one mistake that people make if they're young in modeling, or if they didn't live through a crisis in model, is they believe that that correlated default is not a big deal. Meaning, let's just be really specific, the data that's informing all this is historical in nature. There's no such thing as non-historical. I mean, you could pretend like there's non-historical data, but really, if we're talking about, is that person will pay you enough or not, most of what you're using is whatever they've done in the past. So it's historical in nature. And when you've got an AI model that's training off of historical data, and then you have rates increase aggressively over a short period of time, that AI model, particularly given how much cushion was given to the subprime folks, you had helicopter payments, you had all kinds of stuff on attempting to job relief these folks. You had really great employment numbers that would indicate that folks could have gotten a job. All of that is starting to subside right now. This is really almost a pure play subprime name, unfortunately, for better for worse. Now, if you look at my last video, I got constructive because what they announced, it was a little bit unclear, and it was potentially the case that they had found folks that were happy to buy those loans off. Okay. And that is a really cool thing if they can do it, because the demand is definitely there. And so we'll get to guidance in just a second. The key thing there, okay, I have talked about in my Twitter, I probably should do a video on this and just do an update on Blackstone and some of the other private equities. Private credit is by far one of the most in-demand areas of investment right now. Asset flows to private credit is unambiguously happening. And we see it in literally every asset manager that reported, as well as we see it at every bank that has an asset management arm that reported. So it is crystal clear that people, private wealth individuals, pension funds, everyone is going to try to come in and fill the gap that the banks have left by not taking in the securitizations that are basically causing this little company a big, huge problem. In the last quarter, they announced a few different agreements, and I got excited because I thought, oh, you know what? They might actually be able to bypass the classic bank just trying to get subprime loans and find a direct channel to private credit who doesn't have the ability to underwrite and effectively source the loans. And if they did that, awesome, so amazing, so great. And I like that they were particularly going to do it in housing, because your hazard rate's a little bit different in housing, and other people have a different opinion, but I just think that the supply is so tight that they've got a shot if they were to do a bigger portion of the loan book in housing, which they had started to barely talk about. And the things that they were talking about on this quarter and the previous was they still had to train the models to do that. And you will see, even though they took down R&D expense because it's the prudent thing to do given what's happening on the explosion of these vintages, they did not take it down as aggressively as they could have. But so basically, if they could, it does look like, if I was to say anything bullish and constructive, it does look like they have garnered and tried to court, let's call it that, investors that want those loans. They like that type of return. They're happy to fund it, and they're happy to take it off Upstart's balance sheet. That said, my challenge is this number isn't going down fast enough. Okay, this number, let's just go to it. So the way that they're going to do these loans with others is co-investment. I kind of wish it wasn't co-investment. I kind of wish these whole loans were coming off balance sheet, and it may actually, to the extent that they might be able to do this, they might just be able to write down these other loans. Because let me show you where it's showing up, just in case if you're like, well, where do I find this? Number one, you can find it on the balance sheet in the cash flow statement. It's a little bit not straightforward because you kind of have to do a little bit of funky math across both cash flow and investment, cash flow and financing, and cash flow and from operations to see see it. So that's a little bit aggressive. But where you can see it is right here, which is interest expense and fair value adjustments. See how this is not, this actually continues to be about the same. And interest expense yeah. So it's kind of like right there that you can see these fair value adjustments continue to be pretty aggressive. That's kind of the deal. And we don't know if those fair value investments are going to continue, number one. And we also don't know what part of this testing data is really just them holding loans held to value, essentially like some of the banks are doing. However, the banks will tell you very clearly that, they either tell you outright, it's only SoFi that'll tell you the average credit score of everybody as a total book. But some of the banks have verbally said it on the call. And then some of the banks, you just know, they don't bank people that are sub 650. So they're just right at prime, et cetera. So that's the problem with Upstart. Let me see. It's been so long since I've done this. Let me see if we got some people on chat. One other thing that's a real problem before I get to that is the guidance. The guidance is attempting to be conservative, but we don't really know at this point whether this is conservative or not. They are guiding for Q4 to be a net income loss. So they're going to take another hit because probably this still needs to work itself out one way or the other. They either sell these loans knowing that the expected cash flows are way lower than they should have been, or they do something and just flat out write it off. And there were a lot of little specific nuances about the write-off part of this in the call. I won't go into those details. I think this is enough. And then EBITDA is zero. So they're actually not going to make any kind of really great cash flow, which means they're going to have to pay people in stock. So they will be diluting this one way or the other. I don't know if that's obvious. They already announced 85.6 million shares. You can see from the income statement that is still another million additional shares. That's probably going to try to pay people for Christmas and try to keep them in the seat trying to fix this company. So that's what you have to be signed up for if you're going to take a long position in this right here. Okay. All right. It's been so long since I've done this, so I appreciate you guys holding in there for me. Let me see. Oh, hey, Israel. How you doing? Thank you for stopping by. What is the number for AMC? Okay. So I don't have numbers on this, but I have some things that I'm definitely looking for. I will definitely be doing a video. So this is kind of my test run to make sure that the software was still working, how it was working, and that I could get everything up and running, and that I didn't have Wi-Fi issues, all that stuff. So that's why I did that. But yeah, the AMC, I'm going to tell you as a preview, the thing that I'm looking for is actually not the numbers that they announce, because I'm pretty sure the numbers they announce are going to be fantastic, but it's really the guidance and what they tell you they're going to do with the capital that's coming in. Popular loaner. That's such a funny name. You're so hysterical. You're so silly. Thank you for coming again. All right. I don't have any questions. If you are watching this video later and have questions, stick them in the comments. I'm happy to comment there. And until next time, bye guys. If you care on AMC, please watch me this evening. Bye.